Welcome back, everybody. Today, we're going to be doing another deep dive. And this time, it's going to be into the world of personal finance and investment regulation.
Sounds exciting.
Yeah, it's going to be a fascinating one, I think. And to sort of guide our way through this exciting and sometimes perilous landscape, we're going to be drawing insights from a chapter on personal finance and investments.
Okay.
And I think this is going to be really relevant to all of our listeners out there because, well, let's face it, most of us aren't financial experts.
Right.
And it's really easy to feel like you're kind of stumbling around in the dark when it comes to making investment decisions.
Yeah, I think you hit the nail on the head there. It's one of the things that I find really interesting about this whole area of personal finance is how often it's treated as this sort of like black box.
Yeah.
You put your money in and you hope for the best, but you don't really understand what's going on inside.
Yeah, it's like magic. You just
Yeah.
like trust that the system's going to work in your favor.
Right. Exactly. But the reality is the more you understand about how the system works,
Hmm.
the better equipped you are to actually make informed decisions
Absolutely.
and to avoid those costly mistakes that could really set you back.
Yeah, no one wants to be, throwing their hard-earned money away.
Exactly.
So one of the things that we're going to be digging into today is this concept of asymmetric information.
Okay.
Now, I know that
Yeah.
sounds kind of jargony.
Yeah, it does a little bit.
Yeah, but it's actually a pretty simple idea at its core.
Yeah.
Basically, what it means is that the people selling financial products often know way more about them than the people who are buying them.
Right.
So it's like, I always think of it in terms of like buying a used car. You go to a used car lot and the seller, they know the car's history, they know any problems it's had, they know its true value.
Right.
But you as the buyer, you're kind of going in blind.
Absolutely. Yeah, you're at a disadvantage.
Yeah, and so you're taking a risk because you don't have all the information.
That's a great example actually, because it really highlights the core problem here.
Hmm.
This information asymmetry.
Yeah.
It creates a real risk for investors
Yeah.
because you're essentially making decisions without having the full picture.
Yeah, so it's like buying a pig in a poke, except in this case, the poke could be like your retirement savings.
Uh-huh. That's a great way to put it. Yeah.
Yeah.
You're really taking a gamble.
And that's where regulation comes in, right?
Right.
It's trying to level the playing field a bit.
Exactly. The goal is to try to mitigate that information asymmetry
Okay.
to make sure that everyone has access to accurate and understandable information.
So it's like having a mechanic inspect that used car before you buy it.
Yeah, I like that analogy, making sure it's not a lemon.
Right. Exactly. But I'm also thinking, even if I had like all the information in the world about a particular investment, I might not necessarily have the expertise to actually understand it all.
That's a really good point. You're absolutely right.
Yeah.
You can have all the information in the world, but if you don't know how to interpret it,
Yeah.
it's not going to do you much good.
And that's where the concept of the free rider problem comes in.
Right.
And this is basically the idea that people often assume that someone else has already done the due diligence.
Yeah.
They assume that someone else has already vetted the investment, so they don't bother doing their own research.
It's like trusting that the used car dealership wouldn't put a lemon on the lot in the first place.
Yeah, exactly. But as we all know, that's not always the case.
Unfortunately not.
Yeah.
So, we've got this kind of double whammy going on here. We've got this asymmetric information where the sellers know more than the buyers.
Yeah.
And then we've got this free rider problem where people are just kind of assuming that everything's been taken care of.
Right.
It sounds like a recipe for trouble.
It can be if you're not careful.
But then why do we even have these financial markets if they're so risky?
That's a great question. And it's important to remember that financial markets do play a vital role in our economy. They allow companies to raise capital.
To grow their businesses, and they provide individuals with opportunities to invest their savings and hopefully build wealth.
Right. So they're not all bad.
Not at all. No,
Yeah.
they're essential.
Yeah.
But just like any complex system,
Yeah.
they need rules and safeguards to make sure that they function fairly and efficiently.
And that's where regulation comes in.
Exactly.
It's trying to walk that tightrope between, protecting investors,
Right.
but also allowing the market to do its thing.
Yeah, it's a delicate balance.
So, you mentioned there are these rationales for why we regulate financial markets.
Yeah.
Can you kind of break those down for us?
Sure. So the first one, is we've already discussed, is to try to correct these market imperfections,
Yeah.
like the asymmetric information we were talking about.
Right. So making sure that no one's hiding rust under the hood of that used car.
Exactly. Transparency is key.
And what about the second one?
So the second rationale is about economies of scale.
Okay.
It's much more efficient to have one dedicated watchdog,
Hmm.
a regulator, overseeing the market than to have every single individual investor trying to investigate companies on their own.
That makes sense. It'd be like expecting every used car buyer to be a mechanic.
Exactly. It's just not practical. And the third rationale is about building confidence in the system.
Okay.
When people know that there are minimum standards
Yeah.
and that someone is keeping an eye out, they're more likely to invest, which ultimately benefits everyone.
So regulation's kind of like a trust builder.
Yeah.
It's like knowing that there's a referee in the game.
Exactly. To make sure everyone's playing fair.
Okay. That makes a lot of sense. But I have to ask, isn't regulation also kind of a pain? All this red tape and bureaucracy.
Yeah, I mean, there are definitely downsides to regulation.
Okay.
It's important to acknowledge that it's not a perfect solution.
So let's talk about those downsides. Where do we even begin?
Well, for one thing, regulation isn't free. Someone has to pay for all those regulators,
Mm-hmm.
and those costs are often passed on to consumers and companies.
Right.
Right.
So that's downside number one. Regulation can cost money.
Exactly. And another potential downside is what's called moral hazard.
Moral hazard. Now that sounds ominous.
It might sound complicated, but it's actually a pretty simple idea.
Okay.
It's basically the idea that when people know there's a safety net in place,
Yeah.
they might be more likely to take bigger risks than they would otherwise.
Oh, I see. So it's like if you knew that your friend was always going to bail you out of debt,
Yeah,
you might be more likely to make some risky bets.
exactly. You might not be as careful with your money.
Right, because you know someone's got your back.
Right. And this same principle can apply to financial markets.
Oh, okay.
If investors believe that the government will always step in to save them from bad investments,
Uh-huh.
they might be less diligent about doing their own research and managing their own risk.
So moral hazard is kind of like a safety net that can sometimes encourage people to take unnecessary risks.
Precisely.
Yeah.
And a prime example of this is the subprime mortgage crisis.
Oh, yeah.
Some people argue that the belief in government bailouts encouraged lenders to give out mortgages to people who couldn't afford them,
Right.
which ultimately led to the housing bubble and the financial meltdown.
Yeah. It's like everyone thought they were playing with house money,
Yeah,
but it turned out to be a very risky game.
exactly. So you can see how moral hazard can have these unintended consequences.
Right. So it's finding that balance again
Yeah.
between protecting people but not encouraging reckless behavior.
Oh, it's a constant challenge.
And then, you also mentioned that no system is foolproof.
Right.
So even with all these regulations in place,
Yeah,
there's still a chance that things can go wrong.
of course. There will always be people who try to game the system.
Yeah.
And regulation can eliminate all investment risk. Markets can still go down, companies can still fail, unforeseen events can happen.
So it's a necessary but imperfect tool.
Exactly.
Yeah.
Just one piece of the puzzle when it comes to building a healthy and sustainable financial system.
Okay, so we've talked about the rationale for regulation. We've talked about some of the downsides. Now I'm curious, what does the UK's system actually look like?
Well, in the UK, we have a system of statutory regulation,
Okay.
which means that the rules and guidelines are set by law,
Mhm.
not just by industry agreements.
Okay.
And the main watchdog overseeing the financial industry is the Financial Services Authority, or FSA.
So the FSA is like the referee in our financial system.
Yeah, you could say that. They're there to make sure that everyone's playing by the rules.
And what are their main objectives?
Well, their main objectives are to maintain market confidence,
Okay.
to protect consumers, and to reduce financial crime.
Those sound like pretty important goals.
They are. But here's a twist that you might find interesting.
Okay. On all ears.
The FSA doesn't monitor all firms equally.
Really?
They actually focus their efforts on the companies that are deemed to be the riskiest.
Yeah. It's like a targeted approach.
Exactly. It's about prioritizing their resources to where they can have the most impact.
So focusing on the players who are most likely to commit fouls.
That's a good way to think about it.
Okay. And you also mentioned this idea of self-regulation.
Right.
Now that sounds a little bit like letting the players make up their own rules.
Well, there is always that risk, of course.
Yeah.
But the idea behind self-regulation is that companies have their own codes of conduct and internal mechanisms for maintaining standards.
Okay, so it's like trusting the players to call their own fouls.
Yeah, in a way.
Mm.
But it can be susceptible to what's called regulatory capture,
Okay.
where the industry being regulated essentially takes control of the regulatory process and uses it to its own advantage.
Ah, so it's like the players convincing the referee to look the other way when they commit a foul.
Exactly.
Yeah.
It highlights the potential conflict of interest that can arise with self-regulation.
But there must be some upside to it, right? Otherwise, why bother?
You're right, there are potential benefits. The main one being that the people working within the financial services industry are the ones who probably understand it best.
Yeah, that makes sense.
They have the expertise to identify potential problems and develop effective solutions.
So it's a trade-off between expertise and the risk of bias.
Exactly. It's like trusting the players to call their own fouls, but knowing that they might not always be impartial.
Okay, so it's a delicate balance again. Um, but this whole conversation about information asymmetry and the challenges of regulation, it actually ties into a really fascinating concept called the lemons problem.
Oh, yes. The lemons problem.
Have you heard of this?
I have. It's a classic economic theory.
Okay, so tell us more about this lemons problem. How does it apply to the financial world?
So the lemons problem, it was actually coined by an economist named George Akerlof.
Okay.
And it basically describes how this asymmetric information that we've been talking about can really negatively impact markets.
Okay.
So imagine we're back at that used car lot again.
All right.
But this time, it's not just that the seller is hiding information about the car.
Okay.
It's that nobody, not even the sellers, can reliably tell which cars are good and which ones are lemons.
Oh, so it's like even the experts are in the dark.
Exactly. And in this kind of scenario, buyers get really wary
Yeah, I can imagine.
because they know there's a chance they could get stuck with a lemon,
Mm-hmm.
right?
Mm-hmm.
So they're less willing to pay a fair price,
Yeah,
even for the cars that are actually good.
right, because they figure, why risk it?
Exactly. Why pay top dollar when there's a good chance you could end up with a clunker?
Uh-huh. So what happens then?
Well, this drives down the average price of all the cars,
Okay.
which makes it less attractive for people who have good cars to even bother selling them.
Oh, right, because they're not going to get a good price.
Exactly. So the end result is that the market becomes flooded with lemons.
Wow. So the bad drives out the good.
Essentially, yeah.
Okay, I get how that works with used cars, but how does this lemons problem play out in, like, the world of finance?
Well, it applies to pretty much any financial product where there's a risk of hidden problems. Stocks, bonds, you name it.
Right.
If investors can't tell which companies are well managed and which ones are hiding losses or potential scandals,
Yeah.
they're going to be less willing to invest at all.
So it's like the entire stock market becomes a giant used car lot full of potential lemons.
In a way,
Yeah.
yeah. And this fear of lemons can actually depress stock prices,
Really?
making it harder for good companies to raise the capital they need to grow.
That makes sense. But what about bonds? Aren't they supposed to be safer than stocks?
Well, they're generally considered less risky, but they're not immune to the lemons problem.
Oh, really? How so?
Right, remember, a bond is essentially a loan.
Right. The company's borrowing money from me, the bondholder.
Exactly. And they're promising to pay you back with interest.
Right.
But what if the company issuing the bond is actually the lemon?
Oh.
They might be desperate for cash and willing to offer really high interest rates
Okay.
to attract investors even if they're not confident in their ability to repay the debt.
So it's like that used car salesman offering a super low price to distract you from the fact that the car is a clunker.
Exactly. And this is where that asymmetric information comes back into play,
Mhm.
because bondholders often don't have the same level of insight into a company's financials as, say, stockholders do.
So they're more at risk of getting stuck with a bond from a lemon company.
That's right. And, the Enron and WorldCom scandals,
Oh, yeah, those were huge.
those are perfect examples of how even seemingly stable companies can be hiding lemons.
Because they were cooking the books, right?
Exactly. They were manipulating their financial statements to make themselves look healthier than they actually were.
And that shook investor confidence pretty badly.
Absolutely. Because it showed how even audited financial statements can be misleading.
It's like finding out that the used car you just bought has a fake mileage reading.
Haha. Exactly. A very unpleasant surprise.
So even with regulations and audits in place, this lemons problem can still sneak up on you.
Unfortunately, yes. Asymmetric information is a persistent challenge in financial markets.
So we really have to be on our guard.
You really do. It's important to be vigilant, ask questions, and not just rely on outward appearances or even seemingly official reports.
Don't just trust the shiny paint job.
Exactly. You got to look under the hood.
Okay, so we've got to be careful out there on that financial used car lot.
We do.
But you mentioned earlier that regulation is only one piece of the puzzle
Right?
when it comes to building a healthy financial system.
Yeah.
So what are some of the other pieces?
Well, Beyond just preventing fraud and trying to level the information playing field,
Yeah.
regulation should also aim to ensure the quality of the investment services being offered.
Quality assurance. Interesting. But how do you even define quality when it comes to something as unpredictable as investments?
That's a great question. And it is tricky because, investment outcomes are inherently unpredictable.
Right. No one can guarantee that a particular stock is going to go up in value.
Exactly. Even the best investors in the world get things wrong sometimes.
So how can you ensure quality if you can't guarantee results?
Well, a big part of it is about managing client expectations.
Okay.
A good financial advisor will help you define realistic goals,
Hmm.
understand your risk tolerance, and choose investments that align with your overall financial situation.
So it's not just about chasing the highest returns.
Right.
It's about finding investments that fit your individual needs and comfort level.
Exactly. It's like if you're buying a used car,
Hmm.
a good salesperson will ask you about your budget,
Right.
your driving needs, whether you prioritize fuel efficiency or cargo space. You know?
I never thought about it that way, but that makes perfect sense.
Right. It's about finding the right fit for you.
Okay, so if we're sticking with this used car analogy, would accountability be kind of like having a warranty on the car?
Oh, I got analogies.
Knowing that if something goes wrong, there's someone who's responsible.
Yeah, that's a good way to think about it. Accountability can definitely play a crucial role in improving the quality of investment services.
Okay.
If advisors know that they have to document their recommendations
Hmm.
and justify their choices, they're less likely to suggest unsuitable products just to earn a higher commission.
So it makes them think twice before trying to sell me a lemon.
Exactly. It encourages them to act in their client's best interests.
But there's always a but, right?
There is a but. We also have to be careful not to swing the pendulum too far in the other direction.
What do you mean?
Well, too much emphasis on accountability can sometimes backfire.
Oh, how so?
It can lead to advisors becoming overly conservative in their recommendations,
Okay.
shying away from potentially profitable but slightly riskier investments.
So it's like that car salesman only showing me the most basic, reliable models,
Yeah,
even if I'm actually looking for something a little bit sportier.
that's a great way to put it. It's all about finding that balance again,
Right.
ensuring accountability without stifling innovation or limiting client choices.
Okay, so we've explored the UK's regulatory system. We've talked about this idea of quality assurance and this ever-present lemons problem.
We've
But I'm curious, how does our approach here in the UK compare to other systems around the world?
That's a good question.
Are there other ways to tackle these challenges?
Absolutely. There are different philosophies and models for regulating financial markets globally.
Right.
Broadly speaking, we can contrast the European model, which the UK generally aligns
Okay.
with the US model.
All right. So let's dive into that comparison. What are some of the key differences between these two approaches?
Well, the European model, as we touched upon earlier, it tends to favor a more proactive kind of hands-on approach,
Okay.
emphasizing upfront regulation through agencies like our own Financial Services Authority, the
Yep.
FSA.
Uh-huh.
So think of it as like establishing a clear set of rules and guidelines for financial institutions
Right.
and then diligently monitoring their compliance.
So a more preventative approach.
Exactly, trying to stop problems before they even arise.
Trying to keep those lemons from getting onto the lot in the first place.
Precisely. Setting a high bar for conduct and oversight.
Okay. And what about the US model then? How does it tackle these same challenges?
The U.S. model, on the other hand, places a lot more emphasis on private contracting and disclosure.
Okay.
It's much more focused on ensuring that investors have access to comprehensive information
Right.
and then empowering them to make their own informed decisions.
So more of a buyer beware philosophy then.
You could say that it's based on the idea that transparency and market forces,
Mm-hmm.
rather than heavy-handed regulation, will ultimately drive out the bad actors and promote ethical behavior.
So it's like the difference between a referee who calls every single foul
Yeah.
versus one who kind of lets the players sort things out amongst themselves,
Yeah.
only stepping in when absolutely necessary.
That's a great analogy. And like any approach, both models have their potential strengths and weaknesses.
Okay, let's talk about those. What are some of the downsides of each model then?
Well, critics of the European model,
Yeah.
with its emphasis on all that upfront regulation, they often argue that it can be a bit too bureaucratic and potentially stifle innovation.
Okay, so all that red tape could actually make it harder for new companies,
Yeah,
especially smaller ones, to enter the market.
that's a common concern.
Uh.
There's also the risk that companies might be become more focused on ticking the regulatory boxes
Right.
than on actually embracing ethical conduct.
I see. So they might find like loopholes or ways to technically comply with the rules,
Right.
but still engage in practices that could harm investors.
Exactly. It's that age-old challenge of, following the letter of the law,
Mm.
but not necessarily the spirit of it.
Right, right. And what about the U.S. model then? What are some of the downsides there?
Well, the primary concern with the U.S. model is, what happens when investors don't actually have the time or the knowledge or the resources
Yeah,
to effectively do their own due diligence?
that's a good point. Not everyone has, equal financial literacy or access to expert advice.
Exactly. And so that reliance on individual responsibility in the U.S. model can create a bit of an uneven playing field.
Right, where less sophisticated investors might be more vulnerable to exploitation.
Exactly.
So in a way, both models have their blind spots.
Yeah, it's fair to say, yeah.
Yeah.
The European model, for all its efforts to prevent problems, can sometimes struggle to keep up with a rapidly changing market,
Okay.
or anticipate new forms of financial trickery.
Right. And the U.S. model, while it's great for those who are well-informed,
Yeah,
may leave less savvy investors exposed
exactly.
to those who might take advantage of their lack of knowledge.
Right. It's a tough balancing act no matter which approach you take.
It seems like it. Well, this has been incredibly insightful. We've gone from lemons to global regulatory models
Take that.
to the complexities of finding the right
Well, it's
balance.
been quite a journey.
It has. But before we wrap up, I want to bring it back to our listener for a moment.
Of course.
This deep dive is all about empowering you, the listener,
Right.
to navigate this world of personal finance with more confidence and understanding. So let's recap some key takeaways for our listeners. What are the most important things they should keep in mind when it comes to investing and protecting their hard-earned money?
Well, I think first and foremost, remember that information is your most valuable asset.
Right.
The more you understand about the financial products you're considering,
Yeah.
the better equipped you'll be to make sound decisions and avoid those costly mistakes.
Don't just take things at face value. Ask questions, do your research.
Right.
Don't be afraid to dig a little deeper.
Exactly. And be wary of those lemons lurking in the market.
Right.
Remember that asymmetric information is a constant challenge, so approach any investment opportunity
Yeah.
with a healthy dose of skepticism.
It's like kicking the tires on that used car.
Yes.
Even if the salesperson insists it's in perfect condition.
Exactly. Trust but verify. And don't fall into the trap of the free rider problem.
Right.
Don't assume that someone else has already vetted the investment.
Yeah.
Take responsibility for your own financial well-being.
Be proactive, be informed. But what if we don't feel confident in our own knowledge or expertise?
Well, that's where seeking advice from qualified and trustworthy professionals comes in.
Right.
A good financial advisor can be an invaluable resource.
Uh-huh.
They can help you clarify your goals, understand your risk tolerance, and navigate the often complex world of investing.
So finding the right financial advisor is like finding a trusted mechanic who can help you avoid those lemons on the used car lot.
Exactly. Look for someone who prioritizes your interests, communicates clearly,
Right.
and is willing to answer your questions honestly and thoroughly.
This has been such an eye-opening conversation. We've covered so much ground.
We have.
From asymmetric information to the lemons problem to the global landscape of regulation.
It's been a whirlwind tour.
It really has. But I want to leave our listeners with one final thought to ponder.
Okay.
We've talked a lot about the mechanics of regulation, the rules, the enforcement, the different approaches.
Yeah.
But what about the psychological impact of regulation?
That's interesting.
It's true that regulations aren't just about setting boundaries and punishing wrongdoers.
Right.
They also shape expectations and influence behavior,
Yeah.
even in the absence of direct enforcement.
I think that's a really important point.
If everyone in the market expects a certain level of transparency and accountability, it can create a kind of ripple effect encouraging better practices across the board.
It's like that old saying, sunlight is the best disinfectant.
Exactly. When people know they're being watched,
Yeah,
they're less likely to cut corners or engage in shady dealings.
absolutely.
It's almost like regulation creates a kind of moral compass
Yeah,
for the entire financial system. And that brings us back to you, the listener.
right.
You're not just a passive participant in the system. By
Yeah.
being informed, asking tough questions, and demanding transparency,
Yeah.
you're actually contributing to a more ethical and efficient market.
You have the power to influence the behavior of companies and financial professionals simply by being an active and engaged investor.
So there you have it. We've gone from lemons to global regulatory models to psychology of the market.
It's all connected.
It really is. And it all comes back to your role as an informed and empowered investor.
That's right.
Stay curious, keep learning, and never underestimate your ability to make a difference.
Words to live by.
And on that note, we'll wrap up this deep dive. Thanks for joining us on this journey into the fascinating world of finance and regulation.
It's been a pleasure.